Good afternoon, Zuber. How are you today?
I'm doing very well, man. I really love these conversations when my guests stop and ask me questions. So, what do you got today?
So we're doing a lot of work around for sale listings and finding deals that
Hmm.
will pencil out as investment properties.
Sure.
And one of the things we are really focused on is gross rent yield.
Hmm.
And in some parts of the country, gross rent yield is may not work, or it may not be the strongest metric. And you need to factor in things like property appreciation.
Hmm.
We stay away from property appreciation because we can't see the future, so it's
Sure.
hard to put it into the calculation. But if you take a modest appreciation, it really does impact the annual returns and the
For
overall
sure.
the total return on an investment. I'd like to get some insight from you as to, like, what's your strategy.
Sure.
Do you go for cash on cash, like an income investor on a
Yep.
stock, or are you a value a growth investor where you're looking for appreciation?
Yeah. So again, all investors are unique and different. And having been doing this for a while, I can talk about both. But we'll start with me specifically, right? Olivia and I. And you're absolutely right. I try to turn every investment into a bond. And how do I do that? It's a very simple calculation. It goes by cash on cash, return on capital. I call it yield. So the math for me is extremely simple. How much cash comes out of my account to secure and make ready a property? So that is down payment,
Mhm.
closing cost, and make ready. That is something that a lot of people miss, right? Especially in the environment we're in today where you're getting deals on, I'll call it ugly or value add properties.
Mhm.
So I want to make sure all that upfront capital that I see going out is included. Now that's the denominator, and the numerator is expected yearly cash flow after the repairs, right? So kind of max rents minus all expenses. And obviously that turns into a decimal, you times by 100% and it's a percentage. So that's what we've done forever. So we're very much, how hard is our money working?
Mhm.
Now, what's interesting is we start this real estate investing journey by evaluating the Silicon Valley, right? California, the Bay Area. And you learn very quickly, even back in 2001, that there's no cash flow. Everything is negative, right? Return on capital is negative. Yields, gross rent negative. It's an appreciation market.
Mhm.
And, we had to ask ourselves, what do we want? And our answer was cash flow because we wanted to eventually replace our income. But
Mhm.
that said, it's not right for everybody. Lots of people, are like, hey, I'll just buy one or two assets in the Bay Area. My job will cover them, and I'll exit in a decade or whatnot.
Mhm.
I think that's risky. I've been through a couple of cycles now,
Mhm.
and anybody who bets on appreciation kind of needs one market to carry them. But that doesn't make it right. I think there's plenty of markets where people have won really, really well on appreciation. That said, kind of smashing those two together, appreciation happens
Mhm.
and tax savings happen.
Mhm.
And I think it's valuable for folks to understand what the future can look like. Because again, I've told people for a long time that the first 5 years suck. It's where all the mistakes happen. But sometimes it's nice to sit back and kind of play with the numbers. What might this look like in a decade if we just had 2% or two and a half
Mhm.
percent appreciation? I think there's value in that, in something that I've probably missed because I've been so focused on yield. And I think it's comforting to kind of step back and kind of say, okay, take a deep breath. It's hard today. Cash flow's tough today, but in a decade, things should be better. So I think there's tons of value there. But to answer your question, I do not like betting on appreciation personally, although I know lots of people that do it.
Yeah, it's funny because I was running some numbers, and I just wanted to see what a 5 year scenario looked like with a 2.5% appreciation
Yeah,
and zero cash flow, not negative,
right.
but zero cash flow. And a 2.5% appreciation on a $300,000 property was, I just used 60,000
Sure,
to get into the deal. I didn't factor in some of those other things.
that's
So I just said,
reasonable. Yeah,
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 60,000 to get in the deal. It's 14% a year. A
yeah.
two and a leverage is a great thing, right? Because
Yeah.
the appreciation isn't on your money that's in the deal. The appreciation is on the total asset. So you're getting a
A-
5x multiplier on that appreciation. So I
yeah.
had overlooked that when we were doing our work on calculating yields and
Mhm.
finding deals. And I had a specific customer who's in the Silicon Valley area,
Sure.
Northern California, and they said we were doing the cutoff at 500,000. He
Mhm.
said, "You can't touch anything at
Yeah.
500,000. I want to see
Yeah.
900,000 up to
Right.
900." So we raised the limit as to the deals that we'd evaluate.
Sure.
None of them cash flow,
Of
right?
course.
Or the gross yield. Let's say just you take a basic 1% rule against
Yep.
them, and then you run some simple cash on cash.
Yeah.
There, if you can keep it above negative, you're doing great. Buy it,
No.
right?
Yeah.
but
Exactly.
but it got me thinking, like, how many in the market are because when you think about it, if even if it's a modest cash flow and a
Mhm.
modest appreciation, you've got debt reduction there, so
Yeah.
you're
Yeah.
building equity that way. So a 5-year window, you can get a pretty good return.
No,
You know,
you're
it's like
absolutely
a hidden return there, the
no.
appreciation.
It absolutely needs to be celebrated, right? Again, I can only talk about what I do and what I teach, and again, I think it's vitally important to see how hard your money is working,
Hmm.
right? So that I'm going to call that yield here. But
Hmm.
once you own it, it doesn't matter, right? You own it now, right? You're pregnant, right? And it, you're going to find out if you're right or wrong. But stepping back and doing that 5 or 10 year calculation should give you comfort, because you're absolutely right. I have this thing called the 55-year spreadsheet that goes all the way back to 1970. And a lot of people go, well, let's compare real estate and stocks.
Hmm.
It's not a fair comparison,
Not at
right? I
all.
don't remember the numbers, but I think stock market's up, like, I don't know, let's say it's up 10 times, 1,000%. In real
Hmm.
estate's up, I don't know, call it 400% or 4 times.
Hmm.
But you pointed out the average down payment is less than 10% when you look at the collective picture. So you need to take that 4x and times it by 10. Now
Hmm.
you've got a 40x versus a 10x.
Right.
And I don't think enough people kind of step back and take a deep breath and realize that, yes, I've got into an asset for 10% or 20% or 25%, but I get all of the upside.
Hmm.
And, oh, by the way, you also, like, over 5 years, you're going to pay down the debt a couple of percent, right? Let's
Right.
not forget that.
Right. Right. You also get the downside.
Yes,
I
true.
mean, leverage is risky. Debt is risky, right? There's a reason they call it leverage, and
Yeah.
you can leverage on the upside, but it works the other way. You can lose your equity
Well, let's
um,
poke at that a little bit, because,
in a
again,
severe market.
you're absolutely right. But this is why I think residential properties is right for most people,
Mhm.
right? Even in 2008, that great crash, and I can talk about my property, Norris Drive. Let's be very specific. People can look it up, 1818 Norris Drive East 93703. We buy it for 107. We sell it for 269. If you look at Zillow, it ultimately retrades at 75. Why did that happen? Well, the person that bought it had short-term debt. They had these 2-year teaser loans that reset and took the payment from $800 to, 4,000 or whatever it was.
Right.
It's no longer affordable. But where I'm going with this is, if that buyer had gotten a 30-year mortgage
Hmm.
and the property value fell 75%, he would not have been forced to sell.
Right.
He could have held on. And that's what's very different about this cycle, because I think commercial real estate investors are screwed, frankly,
Hmm.
because their debt resets at 3 or 5 or 7 or 10,
Hmm.
and residential doesn't. And, I think that's one of the reasons why residential is so safe, is it's a one-way bet. If value falls, great. Don't sell.
Right.
If interest rates fall, you refi, you increase cash flow. If interest rates rise, great, you do nothing, right? So that's why 30-year fixed rate debt in America is such a gift that we don't talk about enough.
Right. Right. And I think again, my starting point was yield.
Mine too.
Let's generate cash. But then the more I thought about it, was if you find a market that you have a good feel about the market, And I wouldn't bet just on feel, but I would bet a feel based on some facts, right?
Sure.
And you say, okay, I've seen this movie before. This probably is a rising market.
Mm-hmm.
I can take a balanced approach here,
Yeah.
and I can have some income, but I can also count on the appreciation, or not count on the appreciation and just get a nice gift 5 or 10 years in the future, right?
Yeah, I mean, there's so much wisdom in that statement and where you're going with this. And I'll give you one more real life example. So when you look at what made Olivia and I wealthy, and again, we've owned real estate for almost 25 years now. I would argue, and I haven't done the math, but I'll be close. Cash flow, positive cash flow, is probably responsible for 10% of our overall wealth. The other, and maybe let's say tax and reductions is 5% of that. That means 85% of our wealth is appreciation. Just buy and hold, right? I keep telling people getting wealthy is 3 steps. And step 3 is you got to hold it for a decade. And that's what you're pointing at. Again, if you can get into an asset, fixed rate debt, cash flow $100, $150, if you could put it in some kind of time machine and just, pontificate what it might be in a decade, it should make you feel really good.
Yeah. Yeah.
And that's what you're talking about.
Yeah. Yeah. And so it's a great conversation. And like I said, there's all types of vehicles in the stock market and the bond market. You can buy any type of vehicle you want. And I think real estate, this type of investing, is still in its infancy.
Oh, for sure.
And over time, as you see, the roof stocks and the turbo tenants and the rent readies and all those guys, facilitate things that can happen with technology, and Rentometer itself, with
Sure.
data and price information. You will see more vehicles that, or more, maybe it's transparency into how do you invest? Like, are you all in on income? You're going to do a house hack and you're just looking for cash.
Rent by room. Yeah.
Or are you you can take a balanced approach and say, I want a mix of appreciation and income. And it again, from other experience investing in other things, it can change how you look at an investment. If you're looking cash only, you say, not touching it. But if you look at the market and you say, I really like this market, it's a great hedge. This piece of property is going to be a great hedge on inflation. So it's a store of value that has a bit of a hedge on inflation. I will be willing to take a little bit less cash, or a smaller cash amount, just to be in that market.
Yeah, I would say it this way, and I think you're pointing at it, is the investor has to know themselves, right? Again, as somebody who's now been doing this for 25 years, in the very beginning, it was all yield all the time. And then as we matured and as we got to some level, we took different risks and we did different things. And, I think investors mature and grow, and we certainly have taken flyers on things. We've bet on, we bought because of, migration or, turnaround in different, gentrification, I guess it's called. So I think it's very wise for Rentometer to add this, kind of, I don't know what you would call it. I think one of the times we talked, you hit like a time machine, and that was going backwards. I don't know what it would be called for going forward.
Yes.
But I think it's important for folks to see what it could be. And again, you allow them to, toggle, 1%, 2.5%, 5%. 5% is probably pretty aggressive, but 2.5% or 3%, it's mind-boggling what that'll be in a decade.
Right.
Yeah, I think you're onto something. And again, Rentometer is out there for folks. Again, people in my community, if they wanted to reach out or see what's going on, what do they do?
Rentometer.com. And if you want to find, I think I've mentioned this before, we're evaluating over 650,000 for sale listings every week. Wow. We have the for sale data, we have the rent data. So we're calculating the yields, and we've added a nice worksheet so you can do a quick cash on cash analysis. And so again, I was participated, or earlier in my career, I was on the institutional end.
Mhm.
and I got into the industry when the largest property owner slash manager was probably 40,000 apartment units,
Mm.
50,000 apartment units. Sounds like a lot, but compared to today,
Yeah,
there's managers that own slash manage 500,000 units,
for
right?
sure. Yep,
Technology facilitated all of it,
for
and I
sure.
see I see the long tail where, with the smaller investors, I see it taking a similar track, and you can do things that you couldn't do 5 years ago,
Amen.
and I think it's just going to keep getting better, and you're just going to
Yeah.
see different
Yeah,
vehicles.
I think Rentometer is really in a nice spot because one of the things I've actually told Dana from Hemlane, kind of the same thing is I think accidental landlords are going to explode in the next couple of years. And again, what's an accidental landlord in my mind? It's somebody who bought a home to live in for their family. They've outgrown it. And instead of selling it, they now realize that they have this asset called a 2% 30-year mortgage that they're then going to lean on and become landlords.
Mhm.
And, I think people are going to go to Hemlane to manage the property. They're going to go to Rentometer to say, what can it rent for and what am I doing?
Yeah.
So, I think you're right on the cusp of what the market needs. So congratulations.
Yes. Thank you.
Yeah, very cool. Well, again, folks, go to Rentometer, see what's what. Mike, you're amazing. Take care. Have a good week.
All right. Thank you. Great to
Mhm.
see you again.